answering your questions about retirement. It's Money Talk with Michael Eastham.
I've been saving in my 401k for years. How do I know if I'm heading toward a big tax bill when I start taking money out?
Taking money out of your 401k or IRA can create a pretty big tax surprise. I totally get it. But this is part of the retirement planning aspect that you need to take into consideration before you retire. It can also be a big issue because remember, all the money inside of your 401k was put in there pre-tax, meaning that when you deducted money from your paycheck and put it into your 401k, that reduced your taxable income on that year's tax return. And that happened every single year. And then, of course, the money that was in your 401k or even your IRA, it grows tax deferred, meaning that you don't pay taxes on the gains or any of the interest and dividends that are paid into that account. But at some point, you got to pay the piper. Uncle Sam is your silent partner in your 401k and your IRA accounts and anything that's similar to that. So it could be a 457, it could be a 403b or a TSP account. All those things are pre-tax accounts that you contribute to get some tax benefits. But you do it for the purpose of getting income in retirement. So when you take that money out, the IRS says, hey, guess what? It's time to pay the piper. You're going to have to pay tax on all of that income, whether it's gains or principal. It doesn't matter. So you've got to have a plan in place to ensure that the taxes that impact those dollars aren't a very massive, unpleasant tax surprise, or we call it a tax bomb. You want to make sure that you understand your income needs, you understand the wants that you have for spending in retirement, and you want to understand where those funds are coming from. Because if you have different types of accounts, well, then you have the ability to maneuver where you take money from and when. Now that is until you reach 73, because at 73, then you've got something called a required minimum distribution. I'm sure most of you have heard that term. Well, that's when the IRS says, guess what? Now you have to take money out of your retirement accounts. And whether it's an IRA or a 401k, you still have to take that money out unless you're still working, you're a less than 5% owner in the company you work for, and you have the ability to contribute to the existing 401k. Now, that's a very important thing to take into consideration, especially for those of you who are of retirement age, but you choose to continue to work. You see, if you still have a 401k and you're still working, that one 401k account that qualifies, you don't have to take RMDs from that account. But any other 401ks or IRAs from previous employers or previous accounts, you will have to take required minimum distributions from those accounts. So planning ahead is probably the best way that you can prepare for that tax bomb, if you will, or minimize the impact of the tax bomb when you take money out of your 401k and your IRA. Hope that's helpful. If you enjoyed this video, please make sure you like and subscribe to our channel so that you get regular updates and can continue to build your knowledge base about investments and retirement and financial planning. Thanks so much.